If you had invested $100,000 just 10 years ago in the right ETFs, you might be watching this from a beach, financially free, stress-free, and smiling. But you didn't. And now you're wondering, is it too late? Did I miss the boat? Well, here's the truth. The second best time to invest is now. In this video, I'm breaking down the 5 best-performing data-backed ETFs that can turn $100,000 into a multi-million-dollar portfolio. I'll show you and John how these ETFs have performed in the past, what their future outlooks are, and in the end, I'll show you an ETF that could turn a $100,000 investment into over $8 million while paying more than $150,000 in annual dividends. But before going into that, let's take a look at how I selected these 5 ETFs. To find the ETFs with real millionaire-making potential, I used a strict, data-driven approach. First, each ETF had to show at least 10 years of consistent performance with annual returns above 10%. That rules out the hype and focuses on proven long-term growth. I also prioritized dividend growth, not just high yields. Every ETF on this list has a double-digit dividend CAGR, which means those reinvested payouts grow fast and fuel serious compounding over time. Sector exposure mattered too. I looked for industries with powerful long-term trends like finance, housing, and innovation that are set to outperform for decades. I avoided funds with high turnover or inefficient distributions that can drag down performance, especially when compounding in tax-advantaged accounts. And finally, I made sure each pick had the right balance of risk and reward. Some offer stable, steady growth, while others are more aggressive with amplified upside. Based on these criteria, the ETF taking the 5th spot is the iShares Morningstar Mid-Cap Growth ETF with the ticker symbol IMCG. If you're looking for that sweet spot between high growth and stability, this ETF checks both boxes. It focuses on mid-sized U.S. companies with strong earnings potential and a track record of innovation. They're not the scrappy startups hoping for their first break, and they're not the giant, slow-moving blue chips either. Think of them as the Goldilocks of the market, just right. These companies are growing fast, pushing into new technologies, and quietly grabbing market share in areas like software, healthcare tech, and specialty consumer products. And while Wall Street isn't shouting about them every day, they've been consistently delivering. Over the past decade, this ETF has averaged a solid 10.17% annually. That's not explosive like a leveraged ETF, but it's healthy, sustainable, and less prone to wild swings. It's a perfect candidate for long-term compounding, something you want in a retirement portfolio or growth-focused strategy. Now, even though IMCG isn't known for big income payouts, it still knows how to grow your money through dividends. The current yield sits at 0.75%, which might sound small at first glance, but here's the kicker. The dividend has been growing at 14.99% a year. And here's why mid-cap stocks deserve more love than they get. Most people chase the big-name tech stocks or roll the dice on risky small caps. Mid-caps, though, they tend to deliver smoother, more consistent returns. They're also surprisingly resilient. When the economy takes a hit, mid-caps often bounce back quicker than small companies and can even outpace the big players when the market is on the upswing. They're lean enough to move fast and big enough to take advantage of serious opportunities. So while this ETF isn't trying to dazzle you with big moves, it's playing the long game, growing steadily, reinvesting dividends, and adapting as the market shifts. Now, let's say John invests $100,000 into this ETF today and reinvests every single dividend he gets. After just 1 year, his portfolio will grow to $110,920. Fast forward 10 years, and it'll be valued at $286,649. Stretch it to 20 years, and John's portfolio will be worth $864,221. And by year 30, his initial $100,000 is projected to reach $2,823,374, paying around $73,320 in annual dividend income, or about $6,110 each month. Out of that total, $480,534 would come from reinvested dividends and $2,242,840 from capital appreciation. So the total value added to the initial investment would be $2,723,374. Next up at number 4, I have iShares U.S. Broker-Dealers and Securities Exchanges ETF with the ticker symbol IAI. If you've ever heard the phrase, "the house always wins," this ETF is a way to invest in the house. IAI is all about financial powerhouses, the brokers, exchanges, and market makers who live and breathe Wall Street. I'm talking Charles Schwab, Goldman Sachs, NASDAQ, and other giants that rake in profits whether the market goes up, down, or sideways. What makes this ETF such a smart long-term move is that you're not betting on flashy stock trends. You're investing in the actual infrastructure of the financial world. These companies aren't in the spotlight, but they're absolutely essential, and that consistency pays off. With a dividend yield of 1.31%, IAI brings in a bit more income, but the real story is in the 12.89% average annual return and the stunning 13.31% dividend growth rate. That combination means this fund doesn't just pay you now, it pays you more every year. This ETF also thrives on volatility. Why? Because higher volatility means more trading, and more trading means more revenue for the brokers and exchanges inside this fund. It's like having a business that makes more money during chaos. Plus, with tech like AI and automation transforming how trades are handled, these companies are becoming even more efficient and profitable. They're upgrading their systems, scaling faster, and widening margins as the financial world gets smarter. So what would it look like if John put $100,000 into this ETF and reinvested every dividend? After just 1 year, his portfolio would be worth $114,200. Fast forward 10 years and that number jumps to $378,106. In 20 years, it's estimated to reach $1,436,806. And by year 30, John's $100,000 would turn into $5,488,420. That amount would pay about $70,990 in annual dividend income, or nearly $5,916 per month. Out of that, $4,846,806 would come from capital appreciation and $541,614 from reinvested dividends. So the total value added to his original investment is $5,388,420. Though these are great returns and solid dividends, there are even better options to come. And in the end, I'll show you an ETF that could turn a $100,000 investment into over $8 million while paying more than $150,000 in annual dividends. But before all that, we need to finish the list first. So third is ProShares Ultra Financials with the ticker symbol UYG. Let's talk about banks, insurance firms, and the financial engines that keep the world running, and how to profit double from them. UYG is a 2x leveraged fund designed to double the daily returns of the Dow Jones U.S. Financials Index. So what's exactly driving this fund? The answer? Some of the biggest and most influential financial names in the world. At the top, you've got Berkshire Hathaway, JP Morgan Chase, and Visa. Then there's MasterCard, Bank of America, Wells Fargo, and even some exposure to treasury bills and index swaps. These companies aren't just big, they're deeply embedded in how money moves around the world. In fact, over 97% of UYG is locked into financial stocks. That is a laser-focused bet on banks, insurance firms, payment processors, and financial innovators. And with Berkshire alone making up over 10% of the fund, you're essentially tapping into Warren Buffett's brain with leverage. The logic here is pretty straightforward. When finance booms, this ETF booms twice as hard. And with an average annual return of 13.35% and a dividend CAGR of 17.19%, this ETF is a compounding machine. And while UYG's starting yield of 0.8% may look humble, The dividend CAGR is a sky-high 17.19%. Based on these metrics, let's say John invests $100,000 into this ETF. After 1 year, his investment will grow to $114,150. In 10 years, it'll be valued at $380,706. Give it 10 more years, and in 20 years, it'll grow to $1,505,645. And in 30 years from now, that initial investment would grow to $6,292,981. Around that time, it'll be paying $129,734 in annual dividend income, or $10,811 every single month. Of that, $5,409,258 would come from capital appreciation and $783,723 from reinvested dividends. The total value added to John's original $100,000 will be a massive $6,192,981. At number 2, we have iShares U.S. Home Construction ETF with the ticker symbol ITB. This ETF gives you a front row seat to one of the biggest housing trends in America. It's built around the companies that are literally building the future, home construction giants like D.R. Horton, Lennar, and PulteGroup. As the U.S. continues to battle a severe housing shortage and millennials finally make their way into home ownership, demand for new construction has surged, and this ETF is riding that wave. Unlike high-growth ETFs that rely on hype, ITB is backed by solid, tangible demand. People need places to live, and supply simply hasn't caught up. That dynamic keeps the construction industry busy and profitable. The ETF's average annual return over the past decade is a robust 13.54%, not to mention a dividend growth rate of 18.3%, which is practically screaming long-term compounding. The dividend yield starts at 0.72%, which may seem low, but not when those payouts grow this aggressively. The more the housing market tightens, the better these companies tend to perform. Throw in government incentives for affordable housing and energy-efficient homes, and you've got a sector that's being supported from all sides. So let's say John invests $100,000 into ITB. Based on these ETF metrics, after 1 year, his portfolio would be worth $114,260. Stick with it for 10 years, and it reaches $385,129. At the 20-year mark, he'd be looking at $1,553,403. And in 30 years, his portfolio hits $6,740,974. That's with $160,729 in yearly dividend income, or around $13,394 every month. From that, $5,726,505 would come from capital appreciation and $914,468 from reinvested dividends. Total value added, $6,640,974. And now topping our list is ProShares Ultra Dow 30 with the ticker symbol DDM. This one is the crown jewel if you want blue chip reliability with rocket fuel growth. This ETF is 2 times leveraged and tracks the performance of the Dow Jones Industrial Average. It includes America's most iconic companies like Apple, Microsoft, Visa, and Coca-Cola, all in one aggressive package that doubles daily performance. Over the last decade, DDM has posted an average annual return of 14.17%. That's massive, but what's more impressive is how its dividend income compounds. With a starting yield of 1.19% and a dividend CAGR of 16.34%, this ETF grows like a weed in spring. Dow 30 companies represent the backbone of the U.S. economy. They span across tech, finance, healthcare, and consumer goods. These are companies that generate real profits, pay reliable dividends, and have weathered every kind of economic storm. With DDM, you're not just investing, you're compounding wealth at double speed. Let's say John invests $100,000 into DDM and reinvests all of his dividends. In just 1 year, he would have $115,360. After 10 years, his investment would be worth $421,878. Push it to 20 years, and you're looking at $1,828,869. And after 30 years, that same $100,000 turns into a jaw-dropping $8,199,191. His yearly dividend income would be $156,239, or $13,020 every single month. Out of the total return, $7,111,297 would come from capital appreciation and $987,893 from reinvested dividends. So ultimately, the total value added to John's original investment is $8,099,191. Want to know how to build a dividend empire worth over $1 million with just a $10,000 investment? Click the video on the screen.